Hey, what's up, stock compounders? Brad here. So, Mohnish Pabrai has released his latest talk. This one, January 19th, with the National University of Singapore. Okay, just released today. It looks like he might be in Turkey right here in a hotel room. This is clearly not his office in Austin, Texas. But as always, whenever Pabrai puts out a talk at a school, a Q&A, I like to share my highlights. I think I've watched every Pabrai talk since like 2015 or 2016. So it's interesting to kind of track the patterns and also the evolution as an investor in terms of what Pabrai is learning and how he's evolving. So without further ado, in this talk, he gives like a half-hour monologue where he shares four different investments that kind of had different frameworks in terms of how he thought about those investments. And then he gets into the Q&A portion. So first, let's talk about these four investments that he lays out. He says 34 years ago, when he was just starting his first business in the IT services industry, one of his clients was a financial services arm of another business. I think it was like an ag equipment company. And he noticed whenever he worked with various departments within this business, they would always haggle really hard for the best pricing when working with Pabrai. But there was one part of the business, the finance arm of the business, that always just gave him what he wanted. Okay, there was no negotiating, there was no haggling. And he got very curious about why this was the case, why this particular piece of the business never really seemed interested in negotiating. And it turned out they were always flush in cash. Okay, the finance arm of the business was always flush in cash. So that kind of stuck with him. And down the road, when he started researching the auto industry, I think it was GM first, and he ended up buying Fiat Chrysler. He really kind of went deep into the captive finance arms of these different auto companies and was able to see the power of this particular business model. And he kind of lays that out a little bit in this talk. Most lending is really susceptible to boom and bust, right? It's not a great business to be in as an investor, at least as a long-term investor. But that's a little bit different with these captive finance arms as a powerful subset of these lenders. And he talks about why. He says when Lexus, the car company, repossesses a car, it's not like a bank repossessing a car, where if a bank repossesses a car, they're not in the auto sales business, right? They just want to get rid of this thing. It's almost like a problem for them. So they send it to auction. They get maybe 10, 25% of what it's actually worth because they just want to make a quick sale and be done with it. With Lexus, when they repossess a car, right? When Lexus makes a car loan to someone, and that car loan isn't paid, they repossess the car, but they know exactly what that car is worth. They can refurbish the car. They can offer, a warranty on the car when they sell it. They're in the business of selling cars, so they can really maximize the profitability of that situation. So that's some of the power of these captive finance arms of these auto companies. And it's not just auto companies that have captive finance arms. He was looking into Deere, the kind of farm equipment manufacturer. Pabrai was looking into Deere and particularly looking at the captive finance arm of Deere, just to try to get a sense, for how powerful this particular piece of the business is. So I don't know. We'll see if Pabrai added that to the portfolio. I'm guessing he didn't. I'm guessing this was just one of those kind of curiosities. He wanted to get a better sense for, how would I value Deere, the equipment retailer, versus the finance arm of Deere. So that's one kind of business. It turns out Fiat Chrysler didn't have a captive finance arm. Back when they were kind of dragged through bankruptcy and restructuring, that piece of the business was sold off. So that wasn't part of his investment thesis with Fiat Chrysler. But he wished it was, because that can be a very valuable piece of an auto manufacturer, auto company. Next, he talks about the funeral services business. So how did he discover this? Way back when, he was looking at failure rates of different SIC codes. And an SIC code basically represents an industry, right? So there's all these companies that operate within different industries. And he noticed the SIC code for the funeral services industry showed the lowest rate of failure. Okay, so there's just, if you're a funeral services business, there's not that many of them going out of business. Okay, there's longevity built into this particular industry. And Pabrai has talked about the funeral services business in many past Q&A sessions. He thinks part of the longevity of these businesses is a result of minimal disruption, right? There's not much innovation that's happening in this particular sector. You put on a funeral, you bury the body. It's all very straightforward. College grads don't have ambitions to start their own companies in the funeral services industry. So there's just not a lot of disruption. There's not a lot of change. There tend to be local funeral services companies that are very entrenched in the community, and they've been around for 100 years or something. So it's a very slow moving industry. Now, what he also noticed, as Pabrai, sometimes to find new ideas, he looks at value line. And particularly, he looks at the low price to earnings companies in value line. There's a particular screener in value line where you can see the lowest price to earnings companies. And he saw a few funeral services businesses showing up, like price to earnings ratio of 2, which didn't quite compute for Pabrai, because here you've got a business that has a very low risk of failure, right? Funeral services business. And then you get a price to earnings ratio of 2, which doesn't quite make sense, right? You've got very predictable revenues typically with these funeral services companies. You know how many people are going to die in a given geographic area. And they're not shopping around for the best price, at 5 different funeral services companies. They're going with, the one that's closest, or the one that the family has been using over the years. So he thought, well, that's odd. Why are they so cheap right now? And what he found out with this particular funeral service company, it was a good business, but they had a bad balance sheet. They had some debt that they had taken on, and a lot of investors weren't really sure if that was going to become a problem. Okay, so there was uncertainty around the debt. Could the company weather this storm? But what Pabrai found out, what he kind of dug into and figured out, is that these funeral services businesses had basically bought up a bunch of different funeral services companies. Okay, so they're like a holding company for these small mom and pop funeral services companies. And what he realized is that, well, they could easily sell off a number of these companies to generate the cash that they need in order to deal with this debt. Okay, so the debt, it wasn't a big issue like the market thought it might be, because they had these assets that could easily be liquidated. So Pabrai bought into this. I guess he did quite well with his funeral services company. And, that's something he's always looking for. It's always on his radar now. Is this a funeral services business? And so he's got that kind of mental model for how that works. He also looks for investments that kind of act like a funeral services business. And one of those is Seritage Growth Properties. And how does that act like a funeral services business? Well, you're taking something like all of these Sears retail stores that, have basically been abandoned, right? They can't be used for what they were originally used for anymore because Sears went bankrupt. And so they're turning them into something new, right? They're bringing them back to life, in a sense. And so that's why sometimes Pabrai refers to Seritage Growth Properties as in the funeral services business, and that confuses people sometimes. But that's the model, the general model that Seritage fits into. Let's see. IPSCO. IPSCO is a steel manufacturer, okay, that Pabrai bought. I think it was the early 2000s. He saw IPSCO was trading at like $42 per share. And they had $14 per share of cash on the balance sheet. And there was 2 years of visibility in terms of deals that were under contract that IPSCO would be earning over the next 2 years. And they were going to be earning $14 per year. Okay. So after 2 years, if you're an investor in IPSCO, you've got your money back. You've got the 14 in cash, and you've got the 14 each year to make up the $42 share price. So Pabrai thought, well, it seems like heads I win, tails I don't lose much, right? Because we've already got this 2 years of contracted revenue coming in that's going to give me my money back. So it doesn't matter too much what happens after that. And I assume, they're still going to be able to make some money after that, right? Because they've got the plants, they've got the inventory, they've got all this stuff that I don't have to pay anything for. So, he decides to buy it. And 6 months later or so, you get another year's worth of visibility, another year's worth of contracted revenue. And it's another $14 in earnings that'll be coming in the next year. So the price goes up by about that much. And then, Pabrai's thinking, well, how much longer do I want to hold this thing? And a company makes a buyout offer for IPSCO. And the price shoots up to like $148 per share. And he was out of there, just like that. And this is really an example of a market that confuses uncertainty and risk, okay? It was very uncertain what IPSCO was going to be making past year 2. But, even if they made nothing, because the price of IPSCO was where it was at $42 per share, there was a very low risk. Okay, so the market was confusing the uncertainty with the risk, and that happens quite often. Pabrai really, that's one of his kind of mental frameworks for investments that he's looking for. It sounds like he's not looking for that as much anymore, because from Nick Sleep, he's really learned the power of long-term compounders, right? So that seems to be where he's shifting away from the 50-cent dollar bills. But IPSCO is one of those examples of maybe buying a dollar for 50 cents or 25 cents even. And the last example he gives is Silicon Valley Bank. And the deal with Silicon Valley Bank, I think this was in maybe 1999 when the dot-com boom was really in full force, okay? And Pabrai was trying to figure out, I don't want to bet on these high flyers, right? Because I see that we're in a bubble here. It feels like a bubble. So I want to benefit from the bubble while not taking the downside risk of being in the bubble. Okay. And so what upside without downside is how Pabrai talks about this one. So he found Silicon Valley Bank, and what Silicon Valley Bank was doing was, they were kind of funding these startups, right? They were making loans to these startups, and whenever they would make a loan to a startup, they would get warrants, okay? So they had all of these warrants that weren't even on the books, right? They were kind of hidden assets. And as these companies started going public, right, in the dot-com boom, in the dot-com bubble, that chunk of the assets for Silicon Valley Bank kind of exploded. And I think Pabrai was able to do like 3 or 4x in maybe just a year or two with Silicon Valley Bank. He actually regrets selling it. It's easy in hindsight to regret selling it, but if you look at Silicon Valley Bank, I think it's done like 20% compound annual growth rate over the last 20 years. Okay, so it would have been a very good one to hold on to for Pabrai. But it was also a great play. He got a 3x out of it in a very short period of time by playing the bubble without having the downside exposure to the bubble popping, which I really appreciate that that particular play there. That's very crafty. The Pabrai was able to identify that one. So that's kind of the 4 different investments that he's been involved with, 4 examples of different types of investments. He's talked about this before, an information edge versus an analytical edge. And Pabrai doesn't have an information edge. Okay, that's, we're in the information age where everybody has access to so much information. So it's very difficult as an investor to have an edge by having more information. Okay. What Pabrai has an edge around is the analytics. How do you take the information available and interpret it in a way that gives you an edge? Okay, so you're seeing something in the information that other investors aren't seeing, or you're just seeing something differently. And I think what enables Pabrai to see things differently than most investors see them is that he's been able to find patterns of how the market makes mistakes, how market participants make mistakes in the market. Whether it's confusing risk and uncertainty, or more recently looking for compounders, investors, not having a long-term time horizon with different investments. That can be a huge edge. If you're looking at a business in terms of where it's going to be 10 or 20 years from now versus, what's going to happen on the next quarterly earnings call. So, if you look at the stock market in terms of how long investor hold times have been, what the turnover has been with these different funds, that time horizon is shrinking. Okay, people are getting uber active, at least now compared to 10, 20, 30 years ago. These time horizons are shrinking, and that provides an edge as well for the long-term investor, the investor who really understands the power of compounding. So, with the analytics edge, it's okay if it's uncertain, right? In the case of IPSCO, if you can't lose, doesn't matter if it's uncertain, because, heads I win, tails I win too, right? That's how Pabrai looks at that one. He's asked, is value investing dead? Okay, and this has been all over, right? People are always talking about this. Is value investing dead? Well, people who ask that, either they're talking about a different kind of value investing, but the kind of value investing that Mohnish Pabrai practices is understand what something is worth. And what is something worth? It's worth the sum of future cash flows discounted to present value. Okay, that's what something is worth. So whether you're buying it cheap or it's a fast growing company, you can still value it. Okay, and if you're paying less than it's worth, you're getting value out of making that investment. You're paying $1 today with the expectation of getting more back in the future. Okay, that's all intelligent investing is paying less today than you expect to get back into the future using, an intelligent framework, an intelligent methodology for figuring out, for estimating what that thing is worth in today's dollars. So all intelligent investing is value investing. The difference between value and growth, that's, really just like, is it cheap? Are you buying it because it's cheap? Or are you buying it because it's growing fast? That's often how people think about the difference between value and growth. But value investing is really just paying less for something today than what it's worth. And if you're not doing that, it's not really investing. It's not investing. It's speculating. It's certainly not intelligent. It's speculating or gambling. He's asked about Warren Buffett, and Pabrai says Warren Buffett is God. Okay, nobody's going to be Warren Buffett. Okay, Buffett is a Swiss Army knife, right? He knows he's got all of these different tools to use in whatever market conditions, so many different frameworks, so many different pattern recognitions he can use to make money on an investment. We don't need to be Warren Buffett to do very well. Okay, Pabrai says you can know 3% as much as Warren Buffett, and you can stay within a very narrow circle of competence, like captive finance, right? Like real estate within, a 10-mile radius. It doesn't matter how small your circle is. What matters is that you stay within your circle. Because once you venture outside your circle, once you venture outside the area of what you know, that's when you get into trouble. Which managers should we follow and clone like crazy? So Pabrai was asked about this, I think in the last couple of Q&As. The first one, he didn't really give an answer. The last one, he said Rob Vinal out of Switzerland, that's RV Capital, and Josh Tarasoff, that's Greenlee Lane Capital. But this one, he gave a different name, Chuck Akre. Okay, so that's Akre Capital Management. And, unfortunately, I'm pretty sure Chuck Akre has retired. So any new buys that we see in here for Akre Capital Management through 13Fs or through, this is ticker terminal, so they'll show some holdings that aren't through 13Fs, like Constellation Software, which is a Canadian company, Topicus, which was a spinoff from Constellation Software. And I don't know where these are from. But any new buys here, they're not going to be Chuck Akre's decisions. I'm pretty sure he's fully retired from money management. So that's unfortunate. But the more important thing that Pabrai was pointing to here is that there's a Google talk that was given by Chuck Akre. I believe it was in 2017. And that talk is really good. I highly recommend it. I checked it out after I watched this Pabrai Q&A. And then there's a podcast with Chuck Akre from Invest Like the Best, or is it Like the Best? Invest with the Best podcast with Chuck Akre. That was fantastic as well. So definitely check out those two resources. I will link to those in the description so you guys can deepen your learning with Chuck Akre. But if you look here, I mean, Chuck Akre's portfolio is a museum of great long-term compounders. Okay, you've got MasterCard, Moody's, American Tower, Visa, Constellation Software. I mean, these are some of the best compounders of the last couple decades. So, you know, if Chuck Akre was still managing money, I would be looking down here at some of the smaller stuff that has a recent buy. There's very little activity in the third quarter for Akre Capital Management. Some trimming with a lot of these top positions. A small addition to Brookfield Asset Management. But that's about it. There's really not much there to dig into. And this is really good. The power of compounding. It kind of digs into the investment approach of Akre Capital Management. What is compounding? I love this example. This example was given, I think, by Buffett in the 70s. The story of Native Americans selling the island of Manhattan for about $20 worth of trinkets. And it turns out, you know, that may not have been a bad deal, right? If, you know, the Native Americans had had a savvy investment manager who could generate 9% per year on that $20. Today, you know, it would be worth, what is this? Too much. Millions, billions, trillions. What's after trillions? Is it quadrillions? So 3.3 quadrillion. Definitely worth more than the current land price of Manhattan. So Pabrai actually gave an example of this where he used 7%. And it came out to, you know, 3 or 4 times as much as the current estimate of what Manhattan is worth today. So either way, 7%, 9%, if you can invest for hundreds of years at that rate, you can start with a very small amount and end up with a ridiculously large amount. That's the power of compounding. But what does it mean to be a compounding investor? Right, the name of my channel is Stock Compounder. Right, what does that actually mean? It means we try to invest in businesses that have the ability to compound internally over the course of many years. To think like a compounding investor is very natural for people who buy small or private businesses. The private investor wants to concentrate carefully on a few business investments and hopes the accountants will report back consistently at the end of each year that equity per share has grown. Private investors don't think about trying to dart in and out of investments on a daily or monthly basis. That's because they're not served up prices, right, by Mr. Market on a daily, on a minute by minute, second by second basis, like we are as public company investors. The approach is so basic it's often forgotten in the public equity markets. In public markets, it's become too easy to get distracted by hour-to-hour market gyrations and all the breathless excitement brokers and the media put on short-term news. Why do you think they put short-term news out? Because they make money. They make money based on trading activity, okay? Keep that in mind. To be a compounding investor, you need to tune out the short-term noise. We think hard about the ingredients required for a business to compound in value over the course of many years. We believe these include, this is really 3 legs of the stool, okay, the 3-legged stool that Chuck Akre talks about over and over again. The first, an ability to generate above average returns on shareholders' capital, high return on invested capital. Okay, return on capital employed. Number 2, opportunities to deploy additional capital at above average rates. This is reinvestment opportunities. Okay, so you've got these great initial opportunities, right? You put capital in, you're getting a high rate of return, but can you take those earnings and plow them back into the business at those same high rates of returns, right? That's what compounding is all about. With compounding, you're earning interest on the earnings, right? $1.10 becomes a dollar becomes $1.10, becomes $1.21, becomes $1.34. You're compounding on those incremental gains, okay? So a great business, a great investment has to do that same thing. So in order to do that, it has to have opportunities to reinvest those returns. And a management team with the skill and judgment to sustain the process of compounding over a long period of time in the face of competition, right? So there's a lot that goes into the people behind the business. Do they have that long-term mindset, right? I mean, you look at Amazon and Jeff Bezos. If you read his letters, I mean, he is focused on the long term. He is not interested in making any compromises to the long-term performance of the business to hit short-term metrics, right? To, hit whatever analysts expect the next quarterly results to be. He doesn't care, okay? And that's really important for this long-term compounding. You'll recognize this as just another way of describing our three-legged stool: business, management, reinvestment. So that's like a very concise way to think about what does it mean to compound as an investor. There's some very essential ingredients that Chuck Akre lays out here. I think that is, again, Pabrai mentions this last piece is really hard to find. This ability to reinvest at high rates for many years. Usually, a business will grow very quickly in the early stages, and then, it will mature, and it won't have any more avenues for growth. So, key is to find a business where, it's not going to plateau. It's just going to keep growing for as long as possible. And, some businesses to study here that have really been able to do that: MasterCard, Moody's, American Tower, Visa, Constellation Software, Adobe, Salesforce. There's some incredible names in here that have been able to do that. MasterCard and Visa, I think, are having trouble reinvesting at high rates these days, but still, you can learn lessons from them earlier in their evolution as well. So I think I will leave it there, guys. Thanks for watching this highlights reel from Pabrai's latest talk with the National University of Singapore and US MBA students there. So hope you enjoyed this. Be ready, guys. Next time Pabrai drops one of these, you're going to get another video just like this. Also, let me in the comments, are there other great investors that put out content regularly that I should be covering as well? Doing highlights videos on as well. I've done a few on Guy Spear. He doesn't put out quite as much content as Pabrai. Terry Smith seems to be putting out more and more content recently, so I'm keeping a close eye on him as well. So without further ado, guys, thanks for watching, and I will see you in the next one. Take care.